All right, so we had a very interesting week in the markets. Obviously, the main thing that people are going to be talking about is Friday was a very red day. The jobs report was really bad. I think it's pretty hard to overstate how bad it was. Obviously, that comes into play as to why the markets were down. Also, Trump is talking about tariffs again, so that's causing some uncertainty as well. I think the biggest piece of news was the MSTR earnings from this past week, but I'll get into that. I'll get into stocks. First things first, I want to tell you, if you get value out of the video, please like and subscribe. Check out the links below. So, in my opinion, the biggest thing that came out of this week was strategy earnings. 14 billion in operating income powered by Bitcoin. This is from Joe Burnett. So again, Michael Saylor put this out. They also increased their guidance as well. 14 billion in operating income, 10 billion in net income, $32.60 in earnings. Guidance going forward, 34 billion operating income, 24 billion net income, $80 earnings per share. Full year 2025 guidance, 30% Bitcoin yield, $20 billion Bitcoin gain. So this is also very important because the shares are currently trading for about just under $370 a share, and if they're projecting $80 in earnings per share, which again they already have 32, so that's not going to be overly hard to do, most likely, barring a major pullback in Bitcoin. That would imply they're at less than a 5 PE. So this is something that I've said time and time again. Obviously, Michael Saylor's a million times better at communicating this than I am, but people do not realize just how undervalued this company is. I mean, even if you want to give them, like an average market multiple PE, like a 15 to a 20 PE, that would imply that the shares should be trading at, at least $1,000 a share, upwards of even $1,500 a share. Another important thing that they announced is if they are under a 2.5 MNAV, they're going to be doing zero dilution. So one of the things that you hear from the average normies out there is, they're just diluting to buy Bitcoin, and that's kind of a half truth. But what they have announced recently is if they are under a 2.5 MNAV, they will be doing zero dilution, right? So that would imply that they need to go up like, I think, probably 40-50% before they would even consider doing any dilution. So long story short, with strategy, I could talk for a half an hour about them, but I think that this is the most undervalued stock in the market right now. They're going to be a top 10 company in the world someday, possibly even top 5, or top company, not top 5, top company, but this will be a top 10 company in the world someday. It's only a matter of time. They already have a $100 billion market cap. It's not like this is like a $2 or $3 billion company where that's something that's extremely unlikely. Like, they're already one of the top 100 companies in the U.S. Like, they're going to get into the S&P. It's only a matter of time. When that happens, that'll be a massive amount of capital that flows into them. And speaking of that as well, going to my next point here, Strategy has acquired 21,021 Bitcoin, 117,000 a coin. This was on last Monday, and again they have 628,000, almost 629,000 Bitcoin, 46 billion at $73,000, just over 73 a coin. So this is just absolutely insane because they acquired more Bitcoin in 1 week than all but maybe 5 other Bitcoin treasury companies have on their entire balance sheet. So they are so far ahead of number 2 that it's really not even funny. And again, strategy, obviously full disclosure, my largest position in my personal portfolio, I don't even think it's close. And the reason is they are so far ahead of number 2, it's not even funny. And not only that, they're so much better at doing what they're doing than anyone else. It's not even funny. I mean, there is none of the other major treasury companies have these preferred shares. They have 4 now, and they're probably going to come out with another one at some point, right? Like, they bought 21,000 Bitcoin in a week. Like, that is absolutely insane. And they're not going to stop, right? They're not going to stop. And the thing that I've said time and time again is this is something that's not going away, right? A lot of people hear about this kind of stuff and they think that it's adding all this risk to the markets, but it's really not. And the reason for that is it's quite simple. This is not FTX. This is not Luna, right? These companies are doing it in a much less, in fact, like orders of magnitude less risky way. People think that what they're doing is adding all this froth to the markets, and it's really not. Because, again, what Michael Saylor said time and time again, he has to continue driving this home because there's so many people that really just don't know what's going on. They are over-collateralized like 5-10 to 1. Right? Like, the only one of their preferred shares that wouldn't be investment grade, I believe, is Strike. But that's because they're partially tied to MSTR, right? So, long story short here, I don't think people realize people are really sleeping on this, right? I'll put it there. MSTR, it's going to be a top 10 company in the world someday. Eventually, the normies are going to figure out that yeah, Bitcoin is volatile, but a lot of people they assume that Bitcoin's volatile, therefore it's risky, but it's not, right? I mean, compared to bonds, compared to T-bills, yeah, it's certainly risky in that it could go down and you potentially could lose money. But when you're looking at investments, the best way to think about investments is it's just basic odds and probability, right? Like if I told you that you could invest in stock A and you would get a 100% chance of returning 5% per year, or you can invest in stock B and you could get a 10% chance of returning 10,000%, right? You are much better off to invest in stock B. Now again, if you're 65 years old and you need the money, okay, but I'm talking if you're 25, right? And this is what it is with Bitcoin, right? Yeah, Bitcoin is more volatile, but the risk reward is much better, right? It's much better. And I've said time and time again that we will know that Bitcoin has reached that point to where it's probably not going to easily outperform stocks and real estate once its financial advisors are investing in it without even thinking about it, once pension funds are investing in it without even thinking about it, those kind of things. Once those kind of things are going on, then we'll know that we've probably reached that point of maturity, of saturation, to where it's always going to perform good. Like I think it will always outperform the stock market no matter what. But there will come a point to where it's not going to beat it by like insane amounts. And the last thing here from the Bitcoin historian, SEC just approved in-kind Bitcoin ETF redemptions. So basically what this is saying is people can sell their shares of whatever Bitcoin ETF they hold and get spot Bitcoin. And this is huge for obvious reasons. I'm not even going to get into it because if you can't figure it out, it's kind of sad. But this is huge, right? This is huge because number one, it makes self-custody that much easier, and number two, it makes it that much easier for the average person to get into Bitcoin comfortably. Because when you tell the average person that, hey, you got to get a hardware wallet and you got to run your own node and all of these things that are completely foreign concepts to average people, it's kind of hard. But when you can tell them, hey, go buy the ETF, the same as you buy VOO or QQQ or whatever, and then once they're comfortable, once they get their feet wet and they kind of know what's going on, then they can withdraw it straight away and get spot Bitcoin, rather than going straight to the self-custody and all that kind of stuff. And I think that it's just a great way for to have a stepping stone per se. So let's get into stocks. Like I said, the stock market had a bad week. I've been saying for a while now that, again, we are overdue for a correction. The markets were down. I mean, it was kind of a weird week because the growth side of the market actually did the best. Small caps and mid caps did the worst. The NASDAQ outperformed, did better than the S&P, but everything was down, at least 1.5%. So it was a pretty red week. And I've been saying for a while that, hey, we are overdue for a pullback. For all we know, we go right back. We hit 6,500 next week on the S&P. I'm not saying that, it's going to happen next week. But we certainly are overdue for a pullback. I would expect, 5, 10, 15%. Now, again, it all depends because there's so many things that could come out of left field that it's impossible to predict. But, I mean, on the average year has two 10% pullbacks. And we have seen one so far, but again, it's highly likely that we see another one, right? So I think that it is only a matter of time, but that doesn't mean that you want to try timing the market. Like I've said a million times, I don't try timing the market. I think it's a loser's game. The best thing to do is the dollar cost average. When the market's obviously cheap, I would probably dollar cost average a little bit heavier, and when it's obviously expensive, you do it slightly less. But I would always have a bare minimum that I'm doing no matter what. Right? I would always, that's my opinion. Obviously, I could be wrong about everything here, but that's my opinion. I always have a bare minimum that I'm investing no matter where the markets are at. I could not use the internet for the next 10 years and it'll do it automatically for me. Right? I have the recurring investments. It happens without me even having to do anything. That's what I do. So let's get into earnings from this past week, because this was the biggest week as far as earnings goes. We had 4 of the Mag 7 companies release. The first one is Apple. Now, Apple did beat earnings and revenue. However, with the tariffs and with some near-term headwinds, as far as the consumer goes, Apple did sell off quite significantly this week. I think that Apple's probably one of the better Mag 7 companies, in my opinion, mainly because they just don't trade at such an egregious valuation like an Nvidia does, like a Tesla does. Although they still are expensive, right? Don't get me wrong, they still are expensive. I still am not buying them here. I would want them, honestly, I would want Apple maybe a low 20s PE at the absolute most. So they got to come down at least another 15% probably. So we're looking at probably whatever that would be, like 160 roughly, 160, 170. So they definitely still are expensive. The next one here is going to be Amazon. Now again, Amazon, a similar story, because Amazon, the tariffs are definitely hitting them fairly hard. They beat earnings and revenue. However, they were also down quite significantly. So again, the one thing that I would preface here as far as the earnings go, the earnings so far this year have actually been solid. Like, they haven't been bad by any means. But given how expensive the markets are, if there's any questions, like any concerns or anything when it comes to guidance, that scares the market. So I think that's what we're seeing here. We didn't necessarily see a bad earnings week, but the markets were so frothy that any uncertainty whatsoever is going to cause sell-offs. Also, we had Meta release earnings. Meta released very good earnings. They were up quite significantly on the week, although they did sell off a little bit after the earnings. But, I mean, if you would have bought them at the start of the week, you'd have been up a little over 8% at one point. So I also think they're way too expensive to buy. Microsoft, also similar story. They released pretty good earnings. They were up nicely on the week. Also, another one that I just think is way too expensive. Next one here is EPD. This is one of my more favorite oil and gas names. I think it's a little expensive where it's at right now. But, however, it did barely miss earnings. It was down slightly on the week. This is more of a dividend play. It's paying a little over a 7% dividend. If that's what you're looking for, this is kind of why I like that. The payout ratio is about 82%, so a little bit of uncertainty there. But again, oil and gas prices are a little bit lower than they probably otherwise would be, given the economy is a little weaker, but we'll see how that goes. HIG, this is a company that I am actually buying right now. There isn't actually a whole lot right now, given how expensive the market is, but this is one of them. They released very good earnings. They easily beat earnings. They were up quite significantly on that news. I guess just under 4%, but they did sell off as the week went on. But again, I still do very much like this company. Waste Management is one that I really like. This is one of my must-own stocks. However, it is too expensive, right? That's the problem with them. They did beat earnings and revenue. They did lower guidance, though, which is kind of weird because they were up quite significantly on their earnings news. but then they did sell off quite significantly as the week went on. So kind of interesting there. Procter & Gamble, this is one I do not own. They beat earnings and revenue. They were down quite significantly on the week. United Health, one of the worst performing stocks of the year. They beat revenue. They missed earnings. They were down quite significantly on the week. And they're now down over 50% on the year. So RIP to anyone that still has been holding United Health. And to be fair here, I still would not touch them, to be honest. I just think there's too much uncertainty. UPS missed earnings, lowered guidance. They're definitely a little bit concerned about the economy, and partially too the tariffs have played into that as well. So they were down quite significantly on the week. The next one is Starbucks. They missed earnings. They did beat revenue. They were down on the week. The next one is Visa. Visa, very, very good company. I really like them. I've owned them in the past. I sold them because recently I just thought that they were a little bit expensive. They beat earnings and revenue. They were down on the week though. The next one is ADP. This is automatic data processing. This is another one that I do have on a watch list, but it's a little bit expensive, I think, but I do think it's a really, really good company. I definitely would buy them if the price was right. They did beat earnings and revenue, but they were down on the week. If we look at their price, they're actually right on their historical average PE, a little bit below their historical average price to free cash flow, but I just think they're too expensive still, given what you're getting. The next one is Evercore. This is one that I'm also buying right now, one of the few companies. They beat earnings and revenue. They were actually down slightly on the week. ODFL, this is one that I actually sold recently just because with a weakening economy, with the tariff concerns, this is not a company I want to be in, and good thing I did because they were down quite significantly on the week. They did miss earnings. Carlisle, this is one that I also own. They were down quite significantly on the week. They missed earnings. EXR, this is one I have on a watch list. I do like them. Storage REITs have historically performed pretty well. The one concern with them is higher rates definitely is concerning, and a weakening economy definitely is a little concerning as well. Lam Research, they actually released good earnings. However, they were down on the week quite significantly, I think. No, they were down just moderately. I do still like them quite a bit. They're a little expensive where they are right now, but this is definitely one of the better semiconductor companies. And I mean, a 23 PE, not bad. Because I mean, you look at some of these other names, they're trading at a lot higher premiums than this company, and this company is pretty much just as good as a lot of them. So definitely one that I like. The next one is Vici Properties. This is one I sold recently, number one, because they're actually very close to their 52-week high. And not only that, number two, travel to Las Vegas, which, again, they have significant exposure to casinos in Las Vegas, has gone down. And I don't know if it's going to come back soon, to be honest. I mean, with a weakening economy, this is just not a company I want to be owning. Cameco, this is one that I am actively buying. They release good earnings. This is probably the best uranium name in my opinion, so that's why I own them. ITT, this is another one I have on a watch list I very much do like. They beat earnings and revenue. They were up on the week. Lincoln Electric, LECO, this is another one I like. They beat earnings and revenue. They were up quite nicely on the week. SPGI, another one I like. I have on a watch list. I really like this company. They're too expensive where they're at right now, but I like them. They did beat earnings and revenue. The next one is KLAC. This is another underrated semiconductor name in my opinion. They're definitely quite a bit more expensive than Lam Research is, but this one's really good as well. They beat earnings and revenue as well. The next one is, speaking of underrated semiconductor names, MPWR. This is another one that I'm buying right now. I very much do like it. They also beat earnings and revenue. They're up nicely on the week. RMD, this is a healthcare name that I like. I think they're a little bit expensive where they're at right now, but this is definitely one of the better healthcare names in my opinion. I really like them. I definitely would buy them if the price was right. And the last one on the list here, speaking of healthcare names, is Stryker or SYK. Beat earnings and revenue. They were actually down on the week, but it looks like that was later in the week. So they probably sold off with the market. So that is earnings from this past week. Like I said, with the stock market going forward, I think that we probably are due for a pullback, which again, we might have already seen, to be honest. But I think that if we go down another 5 to 10% from here, would not be shocking at all. So, but again, on the flip side, for all we know, we go up, right? And another thing that I didn't point out that I want to leave it on here is there's now a 80% chance that the Fed cuts in September, and that's about 6 weeks away. And going into the week, that number was around 30%, I believe. So it's overwhelmingly likely that we're going to see a cut in September, and more likely than not that we see a cut again before the end of the year. So that probably helps the markets. That might signal the bottom for the next downturn, and that might signal the next uptrend. But again, nobody knows. That's why I mentioned that my strategy is always just dollar cost averaging. So anyway, like I said at the start of the video, if you got value, please like, subscribe, comment, check out those links below, and stay tuned for more.